Welcome back to this channel. This is Unfiltered Forex with me, Clement, and I am here to talk about intermarket analysis. In this video, we're going to talk about what intermarket analysis is, the various asset classes you're supposed to look at, the various correlations that exist in these asset classes, and generally what you're supposed to do with this info and how you're supposed to apply this into your day trading. Okay, so without further ado, let me begin. Definition. Intermarket analysis is a financial analysis approach that examines the relationships between different asset classes or markets to gain insights into potential price movements and trends. So, yeah, that's what it is. It's a financial analysis approach examining relationship between different asset classes. So the core idea behind intermarket analysis is that various financial markets and asset classes are interconnected, and changes in one market can have an impact on another. Well, even before we go too far into this, you already have some idea of one commodity or one item that is affected, whose price is affected by changes in different markets. Okay, so now let me go to an example. Here we are. So this is intermarket analysis, an illustration. This is the example we're going to use. So first you can see there's the beef, goat meat, which is called mutton, but I saw it's better to just write goat meat. Beef, goat meat, chicken, and fish. This is beef and goat meat are red meats, and chicken and fish are white meats. So this is one market, the meat market, and these are different markets. Beef is a whole market on its own. There are factors affecting beef prices and beef production. Goat meat is another market on its own. There are factors affecting goat production, goat meat prices, quality of meat. Fish is another market on its own. Chicken is another market on its own. But all these are meats, and there are two broad categories of red meat and white meat. So let me get to this illustration quickly. We have to draw a line here. So if for example, if it is predicted that the supply of fish is going to dwindle over the next few months. Okay, let's say the fish reserves are falling. Fish is becoming the fish sources are being depleted. So the supply is expected to drop for fish. That's just an example. If the supply drops, what happens? There is a gap in the market left. So people who want white meat but they can't get fish will definitely move to chicken. You get? So when they move to chicken, that of course means the demand for fish has also fallen. So you can see this is a unique scenario where it's common, but if you're not familiar with these concepts, this is a unique scenario where the supply is falling and the demand is also falling. So the demand is falling because people are moving to an alternative source of white meat, which is chicken. So if the supply is falling and the demand is falling, prices are also likely to fall. So fish that was worth $100 now falls probably to $97. You get? So there's a drop in price here. So the extra market, the customers or the clients who have moved to chicken are now driving the demand for chicken up. Demand for chicken is being boosted in this case. And if the demand is going up, That also means with a constant supply, if the supply of chicken does not change, that of course means prices are also going to go up. Not exactly by the same degree as, let me pull this up. Not chicken prices are also going to rise, but not by the same degree as the downfall in the fish prices. So chicken might go up to 120. Chicken that was previously worth $100 might go up to $120. Simple reason is there is now bigger demand for chicken meat, but the supply hasn't gone up as much, or the supply has just remained constant. So yeah, these two markets, this is a fish market and chicken market. They are both white meats, and you have seen that correlation. So yeah, now let's talk about beef before we combine all of this. So if there is a problem with beef, let's say a study or a release, some science guy, they come out and say this beef that people have been consuming a lot of late has problems and can cause health issues. If they say the beef that is being consumed currently in the market is unsafe and can cause health issues, that of course means the, the demand for beef is going to fall. People will now hate or just opt to not buy beef at all. So, yeah, the demand for beef is going to fall. And since beef is becoming unpopular, the supply will also fall because now the farmers will now shift to a more profitable venture or more profitable meat. So the demand is falling, the supply is also falling because of this release, and the prices will also fall. So in this case, beef that was previously going for $100 is now going for $90, for example. That's just an example because the demand is falling, the supply is falling, it's just losing market. And where are these people going? People who liked beef, but they still want an alternative source of red meat, they now move to goat meat. So yeah, you can see the these are two different markets, but they are in the same category of red meat. So the red meat customers who are moving away from beef, they now start buying goat meat. And what happens to goat meat is the same scenario with the chicken story here. Goat meat, the demand is going up. If if assuming both demand and supply are going up, of course there will be a price increase here because the demand that was previously for beef, the market that was previously for beef has now become a new market for goat meat because it's an alternative source of red meat. So goat meat prices are probably going to $110. That's just an example. And yeah, so this is this is a clear this is a clear a very simple explanation of what intermarket analysis is and how it works. Now let me move to the final stage of this explanation. If the scientists, yeah, these scientist guys, if these scientists now come out and say red meat, heavy consumption of red meat can lead to, let's say, something like a shorter lifespan or higher risk, you're at a higher risk of lifestyle diseases if you eat a lot of red meat. That of course is going to cause the demand for red meat to fall. The demand for red meat to fall, and the supply is also going to fall because if this report is trustworthy, if this new sentiment is coming from a trustworthy agency like the government, if it's the government or the World Health Organization that's coming out and saying, hey, if you're eating too much red meat, you need to stop. It's going to cause you lifestyle diseases, blah blah blah. Of course, that means demand for red meat is going to fall. Supply for red meat is also going to fall because Now farmers are seeing the demand is falling, so it's only natural to move to a more profitable venture. So this also means the prices for red meat will also fall. Prices will also fall. And where will these guys go? People who loved red meat, but now they're kind of second guessing. They're saying, "Hey, we just have to move to something else." They're now going to, some of them, not all of them, of course, some of them are going to opt to come to the side of white meat. And white meat now becomes more popular. So white meat in this case, of course, this means both fish and chicken become popular. So there's an increase in demand in white meat. There's an increase in supply in white meat because now that white meat is becoming more popular, more demand, more farmers are moving to poultry farming and fishing. So the supply is steadily increasing to match the increasing demand. That also means the prices here are going to rise. In general, just in general, the prices are going to rise. So this is a clear, simple explanation of what intermarket analysis is. You just look at the factors affecting one market, look at the factors affecting one market, and then look at how it's going to affect another market. Just like that. Intermarket analysis. This is one big market of meat, and you can see it. I've grouped this into categories: red meat and white meat, and there are things. There are even various types of red meat, various types of white meat, and yeah, these prices they affect each other. If chicken and fish become cheaper all of a sudden, if white meat in general becomes cheaper, of course, that means some red meat customers are going to now move to white meat because it's cheaper, right? So this is a classic scenario of what intermarket analysis is. It's just looking at various asset prices of these different asset classes and looking at the factors that are affecting them and looking at their prices and how these prices are going to affect other prices in the asset class. So yeah, now let's go back to my presentation and continue. I think now it's going to be easier for you to understand what intermarket analysis is. Here we are, asset classes. So yeah, intermarket analysis, as we have said here, it's approach determining examining relationship between different asset classes, So yeah, here we are. The asset classes, there are four main classes: stocks, bonds, commodities, and currencies. When you talk about stocks, you know what stocks are. Stocks are companies. Companies like, yeah, just think of any company. They have a stock, and some of them pay out dividends, some of them don't. But anyway, they have a stock price where their shares are publicly traded. Bonds, I'm sure you watched the video where I talked about government bonds and what they are. Government securities, exactly. Government securities and what government securities are. The link should be popping up somewhere. If you didn't watch it, go watch that first. You will need to watch it before you come here. Another asset class is commodities. Commodities, of course, these are very common. There's gold and oil being the major, widely known commodities that are very, very useful in intermarket analysis. Another asset class is currencies. Yeah, this every economy has a currency that they use. The US has the US dollar, Canada has the Canadian dollar, Euro has the Eurozone has the Euro, and yeah, Japan has the Japanese yen. Yeah, different countries have different currencies. Yeah, even different countries, different central banks have different bonds. and different interest rate. So these are the four main asset classes. But commodities are universal. Gold is gold, oil is oil. If you go to Japan, gold is gold. If you go to Saudi Arabia, oil is oil. If you go to the US, oil is oil. Those commodities are very, very rigid. Like they're the same everywhere you go. So these are the four main asset classes. And you can see here, let me use a pen in this case. So and you can see here intermarket analysis, stock market, the bond market, commodity market, and the forex market. Now these where currencies are, and there are factors that affect each of these markets directly. There are factors that affect, okay, there are movements in the commodity markets that affect the stock market directly. There are movements in the commodity market that affect the bond market directly. There are movements in the bond market that affect the stock market directly. There are movements in the commodity market that affect the forex market directly. There are movements in the stock market that affect the forex market directly. So this intermarket analysis is one web that connects all of these asset classes to each other. So let's move on. Risk sentiment. Okay, now this is where we talk about the two main broad categories of these asset classes. Yeah, there are two main broad categories. There are safe haven assets and there are risk assets. So let me go back to my highlighter. So yeah, safe haven assets. These are bonds and commodities. Risk assets involve stocks and currencies. Now, before I continue, before you say anything, you need to understand that this is a broad categorization. Okay, in most cases, okay, the ones that are usually rigid, that they never change, is that bonds will always be safe haven assets. As you saw the video on government securities, I'm sure by now you've watched it. Bonds are considered one of the safest investments in the world. Bonds, so bonds are safe haven assets. And risk assets, of course, stocks are the riskiest assets you will find. Stocks are very risky, and yeah, these are the riskiest assets you will find. Commodities, they vary. Some commodities are risk assets, some commodities are safe haven assets. Currencies also, they vary. Some currencies are safe haven assets, some currencies are risk assets. That of course we'll look at it as we go into this video, how a currency can become a safe haven asset, and at the same time when a currency can become a risk asset. But this categorization is very correct. More often than not, commodities serve as safe haven assets, and more often than not, currencies are risk assets. We'll look at that in a few. Let's move on. Okay, now let's talk about this well-known correlations in intermarket analysis. As you have seen, since this video started, we've been talking about correlations, since how different asset prices affect another asset prices. So yeah, they're called correlations, and there are very many in these markets, and there are common ones, main ones. So before we start, let's say this is very important you note. These correlations are not perfect. They are not perfect, and some of them vary greatly over time. So, the thing with these correlations is they vary over time. That's one very big, big thing you need to keep in mind. During certain periods, some correlations are useless, and during certain periods, some correlations are very useful. So, correlations they vary greatly over time. Of course, this is highly dependent on the current economic cycle. we have a boom and a bust. A boom being a period of economic growth and a bust being during a recession. So these correlations, they vary greatly over time, and they are not perfect. You'll understand that if you're not understanding what I learned, you'll just understand it as I go into this video. So stocks and bonds. Hmm? This is a very common, widely known correlation between stocks and bonds. So there is often an inverse relationship between stock prices and bond yields. Note this. This is bond yields. This will happen. The yields. There's a difference between bond prices and bond yields. So yeah, if bond yields are high and expected to go higher, the stock market falls and is expected to fall further. The inverse is also true. The inverse being, if bond yields are low, the stock market is expected to go higher. Yeah, there's that inverse relationship between stock prices and bond yields. There's that negative correlation. There is a video on yield curves. I'm sure you have come across it. If you haven't watched it yet, the link should be popping up somewhere right now. You should go and watch it. The video about yield curves. That's where I explained this inverse relationship between stocks and bonds. So yeah, continuing, stocks and commodities. The relationship between stocks and commodities can vary, but during periods of economic growth and optimism, both stocks and commodity prices may rise. This is because increased economic activity can drive demand for commodities. However, during economic downturns or recession fears, both stocks and commodity prices may decline. Now, now this is where I talked about. Let's go back a bit. Yeah, now this is where I talked about how commodities can serve as both safe haven assets and risk assets. Now let me go back here. So, during economic downturns or recession fears, both stocks and commodity prices may decline. This depends on which commodities you're talking about, because commodities like gold and oil, those are safe haven assets, and they do very good when the economy is falling, because if you see the economy is doing bad and is likely to continue doing worse, you'd rather invest your money in these precious metals and wait for a return or a small return, as opposed to investing your money in the stock market and losing half of it or even 30% in 2 or 3 months. So yeah, commodities, some of them are safe haven assets like gold and oil. They are safe haven assets. So this point is very controversial. It depends on which perspective you're looking at them from. Continuing, currencies and commodities. So certain currencies, often called commodity currencies, are correlated with the prices of specific commodities. I'm sure you've heard about the Canadian dollar versus the US oil. They are positively correlated because Canada is a leading exporter of oil, which, okay, some of these correlations, like we said above here, they vary greatly over time. That's why this point is short. This point on currencies and commodities. That's why this point is short. I don't want to explain too much because this is where this what do you call it? This let me use a pen. That's why this point is short. This point about currencies and commodities. Because here, that's where this disclaimer is very much alive. These correlations, they vary greatly over time. So you can see here I've not even listed any example, and I've only mentioned about the Canadian dollar and oil, which of course they are, even that correlation does not exist in the market for during some periods. Yeah, there are a lot of things that affect the oil price. There are a lot of things that affect the price of the Canadian dollar, and that correlation is not among the main factors. So yeah, you just have to ignore that point. Moving on, currencies and interest rates. Now, if you're a frequent visitor to this channel, I'm sure you know about this already. Exchange rates can be influenced by interest rates differentials between countries. High interest rates in one country can attract foreign capital, leading to a stronger currency. Conversely, lower interest rates can lead to a weaker currency. So, like you saw, it was just the other day. We're talking about the European Central Bank decision. The European Central Bank, they hiked the interest rate and then they said this is probably the last one. So that interest rate expectation, the fact that investors are expecting interest rate to go lower, is of course going to make that currency become weaker. Yeah. And if you look at the currency like the dollar, interest rate expectations are high for the dollar. So investors are expecting the dollar is going to maintain those high rates, and therefore that currency is also going to be strong because of high interest rates expectations. So yeah, that's it about that one. It's very common and very direct. This is usually true for most of the time. This is not one of those correlations that vary greatly over time. No, this is usually very true, especially now when almost the entire world is going through this big tightening cycle. That's where this correlation is very pronounced. So yeah, gold and inflation. Gold is often seen as a hedge against inflation, where there are concerns. Where there are concerns about rising inflation, investors may buy gold as a store of value, which can drive up its price. So yeah, as I said in the past, in the previous slide here about stocks and commodities, some of these commodities they do good even when the economy is doing bad, like gold, because it's supposed to be a hedge against inflation. When inflation is running hot in an economy, people buy gold. Yeah, and when the economy starts to fall, that means the stock market is likely doing bad, and people again buy gold because they don't want to put their money in the stock market where it's going to lose value, a lot of value in a very short time. So yeah, gold is mostly a safe haven asset, and it correlates positively with inflation. High inflation, gold prices are likely to go up. Oil and inflation. There is a positive correlation between oil prices and inflation. Rising oil prices can lead to higher transportation and production costs, which can contribute to overall inflation in an economy. So, yeah, this is very obvious. When oil prices increase, that of course means inflation is also going to increase in that country. So, yeah, oil is one of those safe haven assets that people buy when they are trying to hedge against inflation, even if oil is the one causing the inflation. So, yeah, yield curves and economic expectations. Yeah, now I'm sure you've already watched the video on yield curves, and this point makes a lot of sense. The shape of the yield curve can provide insights into economic expectations. An inverted yield curve is often seen as a predictor of an impending economic downturn. I'll not explain too much about this because in the video about yield curves, I explained the various shapes of the yield curve and what they say about the economy and how high the risk level is uh, as the yield curve continues to invert further. So yeah, that's a very major point. Moving on, tips for using intermarket analysis. Okay, number one is to identify the key intermarket relationships. So as you have seen, not all intermarket relationships are created equal. Some relationships are more important than others. Focus on the relationships that have a strong track record of predicting market movements. Yeah, identify the key intermarket relationship. So let's go back to those relationships, and I'll just try to highlight for you which ones you should consider. Yield curve and economic expectation. This one is an extremely leading indicator. And usually for this one, there's a big delayed price adjustment between from the time when the yield curve inverts to the time when the economy, the economic downturn starts. So the yield curve is a very leading, a very leading economic indicator. Oil inflation, yeah, this correlation is valid for most of the time. It's very true. Gold and inflation, of course, this correlation is valid and very true. Currencies and interest rate, yeah, this point is also very valid and true most of the times. This other one, currencies and commodities, yeah, yeah, this other one, currencies and commodities. This one is a big X. Okay, where is that eraser? Let's first try and erase this thing. Don't confuse, don't confuse myself. Yeah, so currencies and commodities. This one is a big X. Yeah, this one don't pay too much attention to it. This correlation is usually not very useful as these other ones. So stocks and commodities. This other one is another one that we're going to kind of just give it half a mark because this correlation, as you have seen, gold and oil are commodities and they are inversely related with stock prices. When stocks are doing good, gold is likely to do not so good because the people, if people want huge returns within a short time, they will invest in risky assets like stocks. So there's a negative, kind of a negative correlation there, not positive as is has been stated in this point. This was just a formality because this is a common belief, and yeah, this is how it is for some times. So this one have a mark. This stocks and bonds, this one is very true. This one is correct, like very accurate most of the time. Come rain, come sunshine, the relationship between stock prices and bond yields will always be inverse. If bond yields are high, and they're expected to go high, the stock market is likely to fall further. And yeah, okay. Even in this one, as you can see, you need to refer this point. This point needs to be constantly at the back of your mind. These correlations are not perfect. Yeah, you get, these correlations are not perfect. Even these strong ones, they are not perfect. The yield curve can invert. The yield curve can invert, and the economy can still be doing good. So yeah, in as much as these correlations are true, they are not perfect. They are not perfect. There's a big delayed price adjustment usually, especially here with stocks and bonds. When the economy, when there's a lot of money in the economy, the delay will be big. Yeah. So I believe we talked about that. Let's go back to here where we were. Huh. Monitor the intermarket relationships on a regular basis. Okay, so here is in the case of if you're monitoring commodity prices, they do move significantly in a day, and that can be something big to look out for. So yeah, intermarket relationships can change over time, so it's important to monitor them regularly. This will help you identify potential market turning points, and confirm other analysis methods. So use intermarket analysis in conjunction with other analysis methods. Yeah, so intermarket analysis, as you have seen, is not a silver bullet. It's a very useful form of analysis to do. It's a branch of fundamental analysis. It's a very useful form of analysis to do, but it is not a silver bullet. It's best used in conjunction with other analysis methods such as technical analysis and fundamental analysis. So yeah, that was it. I believe you've understood all that stuff we've talked about. If you haven't understood, just go and rewatch it. You're going to understand eventually. Something I should talk about is no, that other thing I'll not talk about it in this video. So yeah, I hope you've understood everything you needed to get, and now call this a wrap.